Welcome everybody to today's webinar. I'm Brian Daingerfield. I co-head G10 FX Strategy here at NatWest, and I'm based out of the US. And today I'm going to be focusing on the US election, the result, and the impact that it's had on markets and our own expectations for markets. You know, over the past month, we've seen changes on the political front in many major economies. You've seen lower house elections in Japan have led to some interesting changes there. We've certainly had the UK budget, which everyone on this call I'm sure is familiar with. Germany may be heading towards early elections now, but the biggest change in the last month, of course, has been the US election, Trump surging to victory with united Senate and House. And if you can move to the first slide, please. Just a summary of where we think we are. Trump's win was a mandate win to impose economic policies, economic changes. The fact that voters gave the former president not just a victory, but a decisive victory with a House majority likely and a Senate majority now locked in, we think was a mandate specifically to make economic changes. Now, voters want lower prices. That was their main input. Whether Trump could be successful in delivering lower prices for consumers remains to be seen. But voters gave him a mandate to try his policies out, where Biden's policies were seen to have failed and Kamala Harris really struggled under that. So it's important to think, you know, when we think about what the potential outcome is from a political perspective, from a mandate perspective, Trump was given a mandate by the voters to make significant changes. And I think the Republican Party understands that. And as a result is maybe less likely to stand in the way of some of Trump's significant policy agendas. So what does this mean for fiscal policy, for tariffs? I think most roads lead to higher, whether it be higher tariffs on imported goods. We'll talk more about the specifics on that, but I think the risk is greater for tariffs on imported goods from China, which could come into effect relatively quickly. Global minimum tariff has also been threatened. That feels a bit more like bargaining tool than actual implementation risk, but it's something we'll touch on in a moment that Trump has the ability to do. That could increase prices for individuals if businesses opt to pass through those cost increases from higher tariff rates onto consumers. Additionally, Trump won a mandate to deliver additional tax cuts, both in the form of passing his extending and expanding his existing law, the Trump Tax Cuts and Jobs Act from 2017, expand and extend the expiring provisions of that bill, and also adding in new tax cuts to that package. So Trump has talked about, among other things, cutting the top corporate tax rate by from 21% down to 15%. Additionally, some individual measures as well, things like exempting Social Security benefits and tipped wages from taxes. So Trump is talking about very significant fiscal increases in spending, new stimulus, but not necessarily significant revenue offsets. The only ones he's really talking about are pulling back unspent funds from green subsidies from the former Inflation Reduction Act, which was the big climate spend bill under the Biden administration. Not all of the funds from that bill have been allocated, so he's hoping to claw quite a bit of that back. But then also revenue from increased tariffs. But the increase in revenue is unlikely to match the potential deficit expansion coming from taxes. So as we look into the back half of 2025, we could see significant new fiscal stimulus coming through, and with it, additional Treasury issuance to cover that deficit spending. Taken together, we have higher stimulus for individuals and for corporations, and the potential for higher tariffs that could come from additional price increases for imported goods being passed to the consumer. And so for the Federal Reserve, we think that means a lower easing cycle and a slower easing cycle that ends at a higher rate. And we'll talk about what that means for the dollar. In terms of fiscal policy, sequencing matters a lot. And, we'll touch on the specifics of that as we go. So maybe we can move to the next slide, please. So let's first mark ourselves to market. Where were we before the election? Where are we now? This is cribbed exactly from our pre-election playbook. I didn't make any changes here. As you can see, my own probabilities had a Trump victory at 45% versus 55%. So I'll let you know that right off the bat, that my own view was that this race was 50-50, which Harris had a good shot at winning. Obviously, we got the Trump sweep probability, which was the more likely of the Trump win scenarios, but effectively tied with Harris split government as the number one. This was the initial Trump playbook, and we've seen parts of this play out so far, and parts of it have not played out. So for example, in rates, we have seen higher interest rates, but not steeper curves in a meaningful way. Instead, we've seen flatter interest rate curve. So interest rates in the front end of the US rates market have gone up more than long end rates. And that's because the market has priced out a significant amount of Fed easing as a result of expected Trump policies. On the FX side, stronger dollar across the board was the initial playbook, as in if Trump wins, you get a stronger dollar. That has certainly been delivered. And that's been a factor of, among other things, higher interest rates in the US and all the expectations for what Trump could mean for trade war, for policy, for fiscal stimulus. We like to think a lot about policy divergence, what's happening in the US relative to other economies. What Trump is promising to deliver is effectively policy divergence in a bottle. He is in one tight package, additional fiscal stimulus at a time when most other economies look a little bit more limited in terms of fiscal stimulus, and monetary policy that maybe has to adjust to that fiscal stimulus by pulling back on the potential for interest rate cuts, and that could be supportive for the dollar. Can you go to the next slide, please? So we've seen this Trump playbook play out in a number of different ways. In the FX markets, what matters the most, as I mentioned, was we've had a big resetting of front-end interest rates because as the markets have priced for additional fiscal stimulus and the possibility of higher inflation because of tariffs, the first order impact has been pulling back on expected Fed easing. Now, the market has done that, and we have done that as well. Relative to where we were before the election, we think the Fed policy rate ends its easing cycle 50 basis points higher than previously. So 3.75 to 4% on the policy rate at the end of the easing cycle. That means the real policy rate in the US, the US policy rate at the end of the cycle, may end up well above the implied neutral level. So this easing cycle, the one that we expect, has gone from before the election being one where the Fed could confidently move in the direction of neutral, now with the Fed maybe staying higher for longer. And so what you've seen is US interest rates relative to their peers, which is on the left-hand side, that lighter blue line, surging essentially from the middle of September when the markets really started to price in a Trump victory until now. You've seen a massive rise in US front-end interest rates relative to their peers. So you're thinking about, since we're looking at the DXY, you're largely talking about euro, but also sterling and yen and other currencies. This relationship, this front-end yield relationship, has traced extremely well with currency performance. So this is overlaid against the dollar index, just showing just how tightly this relationship has been, that as the markets have changed expectations for front-end rates, so with it, the dollar has moved. You can almost not even see the dollar there because it's moved so in lockstep in terms of resetting rates higher. So we have seen this resetting higher now. The market pricing for the end of 2025 now for the Federal Reserve is for the policy rate to be around 3.85%, which is almost exactly where we have it now. So that begs the question, the market now has a lot of Trump-related policy pullback, less easing by the Fed, now in their base case. That base case actually looks pretty close to where we have it now. So the next question naturally would be is enough Trump in the price right now as we sit in this difficult period between what we think we know about the Trump agenda and what can actually be delivered? So that's front-end interest rates. Long-end interest rates also matter for the US, and they also matter for global currencies, especially volatility. One of the things we're watching in interest rate markets, both in the US and globally, is how are investors reacting to the significant increases in fiscal deficits, significant increases in borrowing that will be needed to fund these programs? And this is a really nice way of thinking about this, is this idea of term premium. This is a concept where if investors demand higher yields to own longer term securities relative to shorter term ones, that could be a sign that markets are becoming a bit more worried about supply related issues. And what we saw in 2016 was that when Trump was elected, you saw a big surge in this measure of term premium, higher long end yields relative to front end yields. In 2024, you did see an uptick in the run up to the election. But one of the interesting developments has been you really haven't seen that in the aftermath of the election just yet. But in both cases, higher yields, more policy uncertainty, and with it a stronger dollar relative to our previous baseline. Can you go to the next slide, please? So let's think about, I mentioned this, we're in this pre-implementation stage where Trump has promised a lot and markets are trying to figure out what of that can actually be delivered. So we look at a couple of different of Trump's campaign promises on the right side and compare them to where we were in 2016. And this is our own assessment of whether or not promises made, promises kept, which was Trump's slogan during his 2020 campaign, I believe. Did Trump actually deliver on what he was promising? Because there was the same implementation question in 2016 when Trump won in a shock election. There were a lot of questions about what he could actually get through a Congress that generally was not as full MAGA as he was. In 2024, the makeup of the Republican Party is a lot more Trumpian. So in general, we think the market should be assuming that more of the Trump agenda gets through, but there is significant uncertainty. For example, how much of the tax cuts that were promised can actually get through the door, and how much of it might be, will some conservative Republicans who are worried about spending and deficits potentially block. Back in 2016, Trump's pledge to simplify the tax code, cut the corporate tax rate, was generally met. That goal was achieved, although Trump's more aggressive view on where the corporate tax rate should ended up being not being as much in the final bill. Similar with trade, where Trump made a lot of promises on trade, he certainly delivered on actions. We know the trade war was intense. In terms of actually correcting trade imbalances, not as much success. Turns out it's really hard to turn global trade relationships with a couple of, with a couple of tariffs. But Trump looks very serious about trying that again. Immigration, certainly a mixed record here. Did not build the wall, and then spending, yes, on infrastructure, but no on Obamacare. So Trump's policies, there were some that he was really effective in his initial campaign. There were some where he really struggled. It could be similar this time around, but remember, the Congress is more, the Republican majority in Congress is much more in Trump's favor than it used to be. So we should assume that the Congress is less likely to stand in his way. But this is really critical because the market is trying in real time to figure out what the Trump trade is. What parts of the Trump trade are actually going to happen, and what parts of the Trump trade are maybe going to happen less than he was campaigning on. The trade war is probably where this is most relevant. Can you move to the next slide, please? So let's talk about the trade war. Trump has promised two big changes to trade. The first one is a 60% tariff on 100% of China imports from China. The second one is a global minimum tariff of up to 20% on all imported goods from all sources. I think the former, the risk is very likely that comes into effect quite quickly. Now, there's some, I call it a bluster premium. For all politicians, there's a difference between what you campaign on and what you actually deliver. But for Trump, I feel like this is especially relevant, which is Trump loves to campaign with big commitments. And then when it comes time to implement, that's the moment when you potentially pull back. So is it possible that the initial tariff levels that Trump will try to commit to for China is less than 60% increase and on less than 100% of goods? Absolutely. But frankly, your guess is as good as mine. And it could come down to how Trump is feeling on any particular day, as we saw back in the 2018 trade war when Trump was using policy by tweet to really make substantial changes to his threats about tariff implementation. The point of this slide here, there's a lot of information on this slide, but the real point of this slide is that Trump does not need Congress to enact new tariffs. He has multiple different policy powers that have been given to him by Congress already to pursue additional tariffs. The most relevant one for China is that second line there, which is Section 301. That was the plan that was used for Trump's entire trade war back in 2018 when he was really ramping up the trade war. The authority given to the Trump administration to use tariffs in that statute, it's still on the books today. Biden actually used it in 2024. He used the same authority given by the Trump administration to increase tariffs on electric vehicles and other products from China. So this Section 301 authority is still active and could still be used at any time. This is the reason why we believe that if Trump wanted to, he could make a move towards increasing tariffs on Chinese imports as soon as the first week, really. We could be talking about first 100-day style risk for these tariffs. But there's also the possibility that Trump could implement global minimum tariff using these types of statutes. The one that really stands out to us here is the fifth line, the International Emergency Economic Powers Act, the IEEPA. This is normally used for sanctions. It's used during times of war. It is national security. The general rule of thumb in the US is that if you justify something in the name of national security, you can basically do anything you want. And the anything you want in this case could be tariffs. If Trump says that trade is national security risk, that manufacturing losing momentum in the US is a national security risk, as he had done in his first term, he could pledge new tariffs. And so the tariff push does not necessarily need congressional approval. Now, Congress is held by Republicans. They could and would probably approve Trump moving in this direction. But he does not have to wait for Congress to get its act in order. They don't have to write a new bill. They don't have to go through any sort of legislative process. There isn't any sort of a barter between lawmakers. That doesn't have to happen. So tariffs could, in theory, come quite quickly. We think the China tariff risks are quite real in the first 100 days of Trump's term. Can you move to the next slide, please? Another thing we often get asked about is, what about the Federal Reserve? We do not think Trump can replace Powell, and we don't think it would be worth the effort to replace Powell. Powell made it clear in his recent press conference that he thinks that he will not, that it's against the law for Trump to fire him or to replace him. He made that extremely clear. That's our interpretation as well. The thing is, you can't fire the Fed chair just because of policy disagreements. The Federal Reserve Act is pretty clear about this. You have to fire the Fed chair for cause. So it has to be something like the Fed chair committed a crime. Now, could Trump come out and try and say Powell's terrible response to the inflation during the pandemic, that constitutes a crime, and so therefore we have to replace him? He could try that, even with a united Senate behind him. I think that's going to be a difficult sell. I think Senate Republicans and Democrats alike value the independent Fed enough to try and convince Trump to not go down that road. Another option Trump has could be to replace Powell with somebody else on the board, as in flip Powell with one of the other 6 members of the Federal Reserve's Board of Governors. While he could consider this option rather than firing Powell, just demoting him, the issue is that there's no current openings on the Fed board. So if you want to replace Powell, you have to replace him with one of the group already there. There's only 2 other members of the Fed Board of Governors that were Trump appointees that are not Powell. That's Governor Waller and Governor Bowman. Governor Bowman is more in the supervision realm. It's believed that she will be elevated to vice chair for supervision, replacing Michael Barr, who is a Biden appointee in that seat. And so that means if he wants to replace Powell within the board, he'd have to go with Governor Waller. Now, the question here from my side is this worth the effort? Because I don't take Waller as someone who's going to listen to Trump. If Trump wants to put someone into the Fed who's going to listen to him, when he says he's going to cut rates, that person says, yes, sir. I don't think anyone in this group fits that bill. And so I think there's limits here. It seems to me that Powell's term, when it ends in May 2026 as chair, that will be the moment when we're talking about the new chair is sort of at the end of 2025 and into the beginning of 2026, as in the Fed leadership changeover happens at its regular order. Can you move to the next slide, please? Okay, so let's talk about what all of this means in terms of timings, when we can expect, when's our best guess at the Trump trade. A lot of this is, as mentioned, a lot of this is guess, and a lot of this is, when do we think we'll get a better sense of what's the spread between what Trump has campaigned on, which the market's been reacting to very significantly, versus what actually gets implemented. Right now, in the fourth quarter, we're looking at key cabinet positions who are nominated, in particular, who's at Treasury and who's at USTR. Robert Lighthizer, the architect of Trump's prior trade war, has reportedly been offered the USTR position. The fact that he is not accepted as of this morning is notable, but that is something to watch here, that if someone more fundamentalist, more in Trump's corner on protectionist, then Lighthizer ends up in that seat, that could be notable. If somebody a little bit more kind of traditional markets focused ends up in that seat, that would also be notable. Very similar with Treasury. Robert Lighthizer, as I mentioned, was the trade war architect. If he ends up as Treasury Secretary, that could be very significant in terms of Trump signaling to the market what he wants to do, how he wants to use policy to change foreign relationships, our relationships with our allies on economics. Similar, most expect that Trump is going to pick a financier. Hedge fund manager Scott Bessent is the general consensus in the market for the next Treasury Secretary. But Trump surrounded himself with very wealthy people, and I think it's right to say that Trump's assessment of someone's aptitude is heavily tied to their personal wealth and their business acumen. And so picking someone from finance, from business for this seat looks more likely than picking someone like Lighthizer, but that would be a notable thing. And of course, foreign policy beginning to take shape. Biden is currently a lame duck president. All of global leaders are trying to get a hold of Trump and figure out where he is. There was a report in the Telegraph this morning about Trump considering what the future steady state of the Ukraine-Russia war looks like, for example. Foreign policy changes are already effectively happening. In the first quarter, Trump's inaugurated, and then we're thinking about trade war risk starting because Trump doesn't need additional congressional approval. to start the trade war. You're also thinking about cabinet approvals coming through the Senate, executive orders, Trump doing, close the border, executive orders on ways to change, federal leadership and government employees. And also starting to write the tax law, the complicated process, making the sausage behind actually writing a gigantic tax bill, that starts in the first quarter. Into the second quarter is when we're thinking about taxes really starting to take shape. It took about 6 months from start to finish for the tax bill in 2017, last time they had this opportunity. A similar timeline would put you at around the summer of next year for when a tax bill could meaningfully go over the line. I think the soft deadline for taxes is the end of next year because of how some provisions expire. And then finally, as I mentioned, at the end of 2025, that's when I think is a soft deadline for taxing for tax changes, and then also when we're talking about who will be the next Fed chair, which would be, as far as I'm concerned, on sort of regular timing rather than Trump making a move early. So if I can move to the next slide, please, and I'll pass to Piers just in a moment. But just to sum up where this leaves us. In the aftermath of Trump's victory, we've revised up our projection for the US dollar against most currencies. That includes sterling. In this case, we're looking at sterling, rates per sterling. Trump's win supports the dollar in various ways, whether it be higher inflation from tariffs, more stimulus, less Fed easing. That leaves the US as a better positioned currency, a higher carry currency, higher interest rates, attracting capital, a stronger outlook for the dollar relative to our baseline. A big question from here is how much of Trump is already in the price and how much of the Trump agenda, which markets are currently pricing, actually gets implemented. Because if it ends up going beyond what we're pricing, then maybe the market has more to go in terms of reassessing the dollar. If it turns out the market is effectively pricing Trump as is, that might mean that the dollar is at or close to its peaks for now, and that the market will have to price some of that out. Of course, we should note that we also expect the US economy to continue to moderate. None of the fiscal stimulus from Trump is actually coming in the next few months. We don't think the tax bill doesn't reasonably get out the door till middle of next year. So you still have a slowing economy to contend with in the near term, and that could act to limit maybe the dollar upside from here. But a lot is uncertain based on that implementation. And then finally, just quickly touching on the UK, not the focus of this call, but we still think the UK may end up being one of the highest yielders in the G10 at the end of 2025. That's been a support for sterling in 2024, and we think it can continue to be in 25. So we have a stronger dollar outlook against pretty much everything, and we still think sterling is a currency that can generally perform well in 2025 because of its interest rate position being supportive through the year. So maybe I will stop there and pass to Piers.
Thanks very much, Brian. I should like to say, what a great presentation, and I love your background. I feel very bad that from that great background of a great city, you just come to a little room in Brentwood. But anyway, here we go. So on this slide, I just simply look at price, because I feel a lot of people are under the misconception that markets and events are random, and they're driven solely by fundamental laws and news, meaning that market turns and stalls cannot be timed or predicted. And last month's a great example of this again. From my 40 years of studying the markets and charts tell us otherwise. Charts were around way before modern day economics, but just not as widely publicized. Markets are driven by mathematical order and history, and usually it's the same sort of patterns, retracements and cycles we see time after time. Hopefully through the following slides, you'll see what I mean by this. I'll go through the charts. It will be quite fast. If there's any part that's too fast for you, if you would like to go through anything in a bit more detail, just contact your salesperson and we can arrange a separate session for you. So the first slide is the dollar index. This is a chart I've had up for, a couple of years. And the important thing is this 38.2. We can see the move down. So it's been a long move down since 1984. It bounced up 2008. And since then, we'll see the 38.2% has held it. We can see it clearer if we zoom to the next slide. So on this slide, here we go. There's that 38.2%. So literally now, for 6, 7, nearly 8 quarters, that's held the dollar index, that 38.2%. It's a simple mathematical thing. You go up there, you sell it. You're not ready to buy the dollar for stronger dollar. So as it came down, where have we been saying all year on the charts? We've been saying, look for a move, any move lower, support in the 99-100 from that 20 period moving average, the pink line, and we also had that 99.85 behind, which was the 99. Last quarter, we got to the pink line. What do? You buy the pink line. So this month, you've seen a massive rally. back up to, where's the line above it? The 38.2%. It really is that simple. I know there's been an election, there's been the FOMC, there's been things going on, but we can make it simple. Markets are mathematically driven. So it's found support off that 20-period moving average. So we know the 99, 100 is our support. That's the support we're going to watch. We also know the 106 is the resistance. So if price gets above 106.60, that's where the dollar is starting to get, yes, we are going to go a lot stronger from here. At the moment, you're just bouncing up off that sell. So you sell it to that pink line, you buy it off that pink line. So we're going to see it stall around this 106.60, I imagine, initially. If it breaks through that 106, 106.50 resistance, 109 is the next target up that it goes to. As it comes off that 106, let's say it does come off that 106, and I'd imagine there'd be a bit of a pullback, it should find support in the sort of 105, 104.80 area. But the strong support is in the 103.90 area. So that 103.90 area, only below that, it starts to show dollar weaknesses coming, and the market isn't quite as confident of this bounce off the 20-period moving average. So the bit we don't imagine at this stage is that it breaks that 99, 100, but that's the only place where you turn negative dollar. So at the moment, you're in the between, you've rallied off one, you're stalling at the other. Keep watching that 106.60. It's the key, and I've said it all year. Right, so we go to the next slide. This is euro dollar. I love this chart. It's just so simple. You have a trend line from 2000 up to 2000, well, to the present day. It held a support. 2022, it broke. It switched from support to resistance. So the rally back up, we know it stopped at that level. So we go to the next slide. I zoom in. This is just to show where the levels all come from. So there it is. So for 2 years, euro dollar has simply stopped at the initial retracement of that move down, which is 110.72. You haven't had a quarterly close above it. And this is what I say when markets are mathematical. Every quarter, there's been a reason why apparently it comes off. Okay, this one is the US presidential one, but it's just another story. But it's that line that holds, 23.6. Look where the 20-period moving average is, at the same area. So if euro dollar is going to go higher, it needs a quarterly close clearly above 110.72 and that 20-period moving average. Then it will go for the trend line. But look, it fell off the trend line in 2023. It's rejected it. So at the moment, it's still in a negative feel from breaking off that trend line. So where's support? The support we can see for the last few years has been down that 104.66. So that's where I'd expect some support to come. In this 104.66, 106 area is where we're going to see some initial support, I feel, on euro dollar. If it starts to get below 104.60, then the whole big picture changes for euro dollar. And that will probably coincide with the dollar index breaking through that 106.60. But we'll keep you posted as we go on from here. So at the moment, I'd like sort of like 5-cent range, 104, 106 up to 110, 109. But I think actually probably it would struggle to get above 108.20, maybe 109.50 euro dollar. I think if it rallies back up, that's where people would sell, again, targeting that 104.60 area. But again, these are exactly the same lines as we've had for the last few months and on the quarterly chart for ages here. So nothing new on euro dollar. And it's nice to be able to say that, because a lot of people seem to think there's a lot of change going on in euro dollar. No change from the chart point of view. So we go to the next slide. Sterling index. Again, no change sterling index. Last webinar, I said I'd expect 69.70 area, because that's a 61.8%, to act as resistance. We can see that it hasn't really managed to break through that resistance. It's sat there for a couple of months underneath that 69. It's come down. It's tested the 50% at 67. So that's your initial support, a 67, 69 trading range. Where does sterling start to get interesting, or a worry, shall we say, a concern that actually, look, maybe it's starting to lose its shine? If you get down below the sort of 64.50, 65 area, I would get worried. But at the moment, you look for initial support, 66.50, 67. So again, no real change to last month. Everything looking good. So we go to the next slide, euro sterling. again, no change. Why is that? You had a trend line, and this is a trend line. We've done this many times during the year. It's a simple uptrend line. In the pink bits, you can see, in the pink circles, you can see where it bounced and rallied, making the trend line. The blue bit was earlier this year when we broke below. I highlighted it on the webinars. You can see now that just to make things worse as price falls off, on the Ichimoku cloud, the lagging line, and I've indicated it in that with that arrow, it's just behind the 3 on the pink circle. The lagging line is now below the cloud. So that gives more impetus that, you know, we're going to see a move lower. Now, actually, I've just only realized on these, we normally do sterling euro. So let's just click on 2 more slides. For those who want euro sterling, the slides are there when the pack comes out. But sterling euro, same thing. Downtrend, look at that. Nice downtrend. You broke the downtrend line earlier this year, and since then, all it's done is gone up. You break a downtrend, trend line breaks, market rallies. Simple as that. So what are we doing? We're going up, but also the lagging line. So the lagging line here is breaking above the cloud. So that's all positive sterling euro. But where can we look for levels? You know, if we want to look at support, resistance, what can we do to sort of find where's support and resistance? Let's look at the next slide. Let's put on the retracements. That always helps us. So what can we see? We can see 38.2% of that move down, 121.40. Now I see the 121.40, let's call it 121.5, 122. I see that as a little area where you could see some resistance in sterling euro. So I sort of look at that as the top at the moment, 121.5, 122. If it starts to break above that, something's changing and the market's getting much more confident on sterling, much more negative on the euro. But I think that if we see pullbacks lower, where could pullbacks lower go? They'll probably go down and find 118.50 as support and the 116 area. The 116 is the initial retracement. So that 2 cent there, 116, 118.50. If you want sterling euro higher and you don't want it to break lower, you want to see that area hold on pullbacks. If you want sterling euro lower, you want to see it break low below there, and then you'll see further follow on through. But because of the lagging line going through the Ichimoku cloud, I feel a bit more positive on sterling euro. And I think dips will find attract buyers. So we go to the next slide. Next slide is sterling dollar. So this is where the whole move comes from on sterling dollar. So when we look at this chart, it shows the whole move down that we've got from about 2007, 2008, where it's about 211. And then sterling dollar basically halved. It went from 211 to 103. And 103, it bounced, and we added on those retracements. Once you know the low and the high, you can put on the Fibonacci retracements. So if we go to the next slide, we're going to zoom into what was happening there. So here we go. This is that last bit zoomed into. So we can see for the last year, nearly 2 years, that first retracement, 129, and the 20 period moving average held sterling dollar. Then last month, last quarter, I mean, you closed above it, clearly above it. And so it was the case of, right, we're above that. What happens here? So there's a risk it could go higher, but it's coming straight back down, which is never good after a break. You would want some follow through. It's like if you've gone out on a date with someone, you've taken them out, you spent a lot of money, gone for a nice meal, you'd expect them to ring back, you know, quite soon. And here it didn't happen. They haven't rung back. The market's just collapsed straight off. Now, last webinar, I spoke about support being in the 128, 129 area. And until today, that held really, yesterday and today. And that was where we saw the market come back down to the 128, 129 area. But we also marked that 127, and that's quite a key area. So I think just at the moment, I'd just be watching how far does this pullback go and how long does it last? Because if it closes this quarter below that 23.6 and the 20 period moving average, that gets classed as a false break. Price tried to get above the resistance and it failed. You need 2 sessions above a line to classify as a true break. And you didn't quite get that there. So you might get it if it rallies back up now. So as it's coming down, let's talk about where the risks on the downside. Now, if you've got my daily charts up at one sort of 34 area, I told you about a risk reward coming on the change, coming on the daily charts around the 134 area. Now, I'm just starting to say on my daily charts now that on this move down, I'm starting to think you're approaching short time where you see a change in risk reward on the downside. You might start to see a bit of a pullback higher. So initially, I'd look for support in the sort of 126.40, 126.90 area. So that 126.40, 126.90 should hold sort of the market. But it might, at a push, go down to 124 and then sort of come back up. But where's the real change happen on the downside? Because a level we have on there for some time, if you look at that level, the orange line, I call it the change area, it's 122.5. So if you look, since the first rally back up, when it's gone sideways, that's always where it's managed to attract some buyers in. People have come in and said, yeah, this is far enough, we'll buy sterling dollars going higher. If you get a quarterly close below 122.50, I think it's game over for sterling dollar and you're going lower. So it's quite an important area, the 122, 124, definitely as a zone. But in the short term, watch 26.40, 26.90. So where does sterling dollar start to get positive again? I've had people ask me that. Oh, where can we say it's all positive? Well, you need that quarterly close above 129. On the next slide, I put the monthly chart on. So the monthly chart, you can see you're coming back down off that 76.4% retracement of the collapse from 2021 to 2022. The 76.4 held it on a monthly basis. And it's fallen back off. So it's coming down to sort of the 126.90, the 61.8, the 127.58, the 126.90 is the 20 period moving average. So that should be support along with that 126.40. So 126.40, 127.50, 1 cent sort of support range, below which opens the 122. But to get positive, where do you want it? You really need it above that 76.4%. Why is that? Because you want to see a higher high, keep this uptrend. So you're still in an uptrend at this stage on the monthly chart because you've still got higher highs and higher lows. It's if that starts to change, which is why that 122 area is very important. Because if you start to break that 122, whoops, the uptrend's over. You're not getting higher lows anymore. It's going to be very, very key. So watch on rallies how it does. Excuse me. I think sort of 129, 131 area might actually cap it for the time being. But I think that there is a slight change maybe coming on the daily charts. But have a look at my daily charts that I send out because I'm all over that moment saying, are we approaching a short-term area for a rebound just a bit higher? And then on to the next slide. This is, I've said about markets are mathematically predictable. You go from one level to the other, one support, one's resistance. This is the other thing I talk about, cycles. Here's the sterling dollar yearly cycle. Every 8 years is normally a down year for sterling dollar. Normally it's been a very negative year. So this year hasn't so far been a very negative year. It was looking very like this was going to break, but we might just get a slightly negative year into the end of the year. But let's just see how that plans out, because normally on the cycle basis, sterling dollar ends up lower than it starts. And the next slide is very important. That disclaims me of everything I said. As I said, that was a very fast run through. If you have any questions, please contact your salesperson and they can either arrange a call. And if not, you can just email a question.